Hey guys, what's up? Stock Retail coming back to you. Just want to talk through Q1 earnings finally. Had a great call last Friday on the earnings and just hadn't had time to get to those, partly because we had some new filings on the court settlement. So I had gone through that in the last video. I know some folks had wanted to kind of know what the process would be there, so I kind of prioritized that. But let's talk through Q1 earnings, how they looked, how they compare to last year, ways that I look at them kind of through a business lens. And then actually, I'm going to come at what's coming next. How does the business look going forward? I will try to make that a little higher level and a little faster than some of the forecast videos, but we'll kind of revisit how's it going? How's the forecast been? How are we tracking against that? So, without further ado, let's just jump in. So, some notable things that I saw, and then I'll actually give you a scorecard that I've done. If you were to see on Reddit, I think I've done that quite a ways back. And so I'll show you just kind of how we're tracking on that scorecard as well with a little more detail. But some notable things. Revenues were up 22% year over year. So if you compare to the first quarter of last year, you may have heard me say sometimes here, certainly if you followed me on Twitter, you would kind of have heard me talk about Q1 is always not always, but most usually the smallest quarter of the year at the box office. So it's AMC's kind of, let's call it, worst quarter of the year. And that's why I'm actually super encouraged with his results, because if this was our worst quarter of the year, it's uphill from here. And frankly, this was not a bad quarter at all. So, as evidenced, if you look at this quarter versus last Q1, actually, there's kind of a thing in forecasting where sometimes you want to look at seasonality. So, like, is something bigger in the summer versus the winter? Like, if you were in golf footwear and apparel, you know that spring and summer are a lot bigger than fall and winter. So, you may not want to compare, say, your fall quarter to your spring quarter if you're kind of comparing quarter to quarter. Well, because of seasonality, what you usually do is compare year over year. So in this case, we're going to compare Q1 to last year's Q1 so that we're kind of comparing apples to apples. Wouldn't make sense to compare it to Q4, when we had holidays and holiday movies and all of that stuff. So year over year, Q1 up 22%, but notice that the losses closed by 30%. In other words, AMC is starting to leverage their revenue. I think the first video I ever made, I talked about that. There's kind of these multiplying effects because AMC has they have a largely fixed cost model. So the more that revenues go up, some of their costs don't really go up with the revenue. And so they start to become more and more profitable. The other is they've been cleaning up their balance sheet. So they've been getting less debt. They've actually been lowering their rents. There's some other things that have been going down. And so what you'll see as revenues ramp up, as the box office gets bigger, I think you're going to see AMC's revenues grow faster than their costs. And so you're going to see a return to profitability quicker than I think some industry analysts have cared to admit. This is the fourth positive EBITDA quarter. So that's earnings before interest, taxes, depreciation, and amortization. We can kind of talk about some of those in a minute. And it's the fourth it's the fourth positive EBITDA quarter post-COVID, and that actually makes 4 out of the last 6. So AMC is starting to have kind of a positive earnings before all those other expenses, and we'll talk about that. There was approximately $120 million cash reconciliation that was booked as an expense. So what that means, of this loss this quarter, if you don't know, 120 million of it was basically AMC preparing for the expense of the settlement. So I think that has to do with not only the lawyers, but also the actual paying out of the stock dividend. And so that kind of has to look like an expense on the books, even though that's not really cash on that part. But so that you know, if you kind of were to just look at the total loss, and Hedgie would love to FUD you with, just a loss number without kind of thinking through what's in that. It's kind of like if you bake a cake, well, what's in the cake? And in this case, this is in some ways, it's kind of like almost a non-cash sort of a thing. Some of it is cash if they're paying lawyers and all that. But anyway, so they booked a big expense. Also, that should just tell you exactly why shorts like to bring lawsuits. There's a $120 million expense in our Q1 earnings because of this lawsuit. Thanks a lot, Allegheny. Okay, so actually, let's just further that point. Allegheny says they're fighting for a class, that class being AMC stockholders. Yet AMC stockholders just had a $120 million loss in the quarter because AMC had to book that expense. I'll let you decide how you feel about that, but I think maybe we should be vocal about that. All right, so significant debt pay down. This is the 4th consecutive quarter that AMC has paid down debt. I'm actually going to graph that for you. It's not small. the debt is going down pretty fast, and I don't think Hedgie wants you to know that. And then lease expenses. So remember, rent, their leases, that's a pretty big expense for them. Lease expenses were down year over year. I told you that in kind of many past videos, that rent has been kind of going the right way. So their lease expenses were down almost $24 million. That's about 9% year over year. So that's, like I said, revenue's up. Some of their costs are down. There's other costs that go up. They're called variable costs. We can talk about those too. So how about that glide path? I mentioned debt is going down steeply. Look at this graph. This goes all the way back to Q4 of 2020. These are their actuals. You can fact check me on this. These are straight from their SEC filings, as I always say. And look in particular how steeply the last 5 quarters have been. From Q1 22 through the end of Q1 23, they're paying down debt every quarter. So here's one reason you really want to know that, and it'll make you sort of FUD proof. Shorty likes to say, look at all the cash that AMC is burning. Well, you understand some of that cash has been used to pay down this debt. And in many cases, that's been extra debt payments. It's like if your mortgage was, I'll make this up, $1,000 a month, but you said, you know what, this month I want to go ahead and pay $1,500. You didn't really have to do that, but now your debt is lower. And so that's what they've been doing quarter over quarter, over and over and over. Look at this blue line, how steep that is. Now, what's been happening to their revenue during that same time? Well, it's actually, so I've drawn this kind of funny because actually if you go back, the revenue goes so low, I just didn't want to show it that way because it would make this line look funny. So you can kind of see from the last few quarters, we've gone basically from 750 million. We just finished this last quarter at 950 million. If I had drawn it that way, everything on the left would look really steep. So we're actually going way up on revenues. But what I wanted to show you, and this is going to lead into some of the later parts of the video, is what's about to happen. Because of the size of the box office in Q2, Q3, and Q4. So look at, now this is my forecast, right? But those little 3 data points up on the top right. So as debt has been flying downward, revenue is just about to take off, and has been going up a lot. Had I kind of scaled this differently, the revenue would look like it's been going up this whole time. But I wanted to show you a little bit of that future view. I just really think you ought to focus on that debt piece. I think you ought to know this. One thing, they said in the earnings call, and I kind of had a little bit of a smile about it because I think a week before earnings, what was it? Oh, there were some accounts out there kind of scaring people about cash, both in the media side and then actually swirling around social media. And I knew that debt had been going down, and I knew that debt was lower than pre-COVID. And I said that in a space call on Twitter, and I don't remember, maybe I tweeted about it or something too. And so then I noticed Adam and Sean referenced that as well, and they wanted you to know that too, that AMC's debt is actually lower than it was pre-COVID. And you can see it's significantly lower than kind of its worst point. So in 2020, nothing was going on, and they kind of took out more debt than they needed just to be safe, because at that time you didn't know how long we were going to be locked down. Well, gosh, since then we're down almost $1 billion. It's a lot of money that we're down, $900 million. So I think you really ought to know the trajectory of that debt. You ought to know that the fact that some of the cash burn has been towards that. And you ought to know, I've talked about this, check out this video, I think I called like the pieces, or kind of how Adam has positioned us. And I talk about there, I said, I don't know, 6 weeks ago or something, that banks are, having this liquidity crunch and really need cash. And there will be banks who will gladly give a major discount to AMC to pay off their debt, because what happens is AMC is giving the bank cash before the debt was due. A lot of this debt isn't due until 26, 27, and 28. This isn't due for years. They could just be paying interest if they wanted. And so the bank will basically say, wow, we really need this cash, we'll give you a big discount. I had said that on multiple videos, and then if you heard in the earnings call, there was some of this debt that was paid down at nearly a 50% discount, which was exactly what I said would happen. And it's going to happen more, in my opinion. I think you are going to keep hearing about AMC paying off debt at a steep discount, 40% and 50% discounts. Again, that's a forward-looking view. It doesn't mean I'm right. It's one point of view, but so far I've been right. I predicted it. It happened. I'm predicting it again. So we'll see. And the reason that matters, let's say I spend $100, but I pay off $200 of debt. As a business, I've actually added kind of that $200 of value in a way to my balance sheet. I've made the balance sheet get $200 better, but I only spent $100. The guy is adding value to this company. And I someone trolled me about the sale of Ape a while back, and basically, maybe I'll just try to retweet this somewhere or something. You can walk through, and if you add the debt payoff that he did, the interest payment savings that he did, and then the debt payoff he did after the Antara deal, because don't forget he used that cash for more debt payoff, which you're seeing in this blue line. And then the discounts he got on that and the further interest payment savings he's got, you can basically demonstrate that the Antara deal, he got roughly twice the value. I think it was more than twice, like 2.3 times the value of the market for Ape at the time. So, people like to troll about that. I can basically walk through, maybe I ought to do a video on that, but if you find the tweet, I sort of do the math there with DD on how really he's adding value. And I have a whole video on dilution that explains that to you guys. Like, dilution can add value to the company as long as a good manager, and I believe Adam's a good manager, uses it to add value. So in this case, if he paid off, say, $100 million of debt, but he only spent 60, we got that extra 40 basically added to the balance sheet, and our stock eventually will go up. All right, this is going to be kind of the last real detailed slide. If you don't like details, go ahead and fast forward a little bit because I am going to talk through where Q2 is going and some other fun news, not just Q2, but going forward, and sort of prove out how great things are going. But I want you to see something I've done every quarter for a couple of years. And I just like to see, usually I'll do this quarter over quarter, but that's that seasonality thing I talked about. So in Q1, I always do year over year. Other quarters, I'm going to track this, quarter to quarter and just watch our progress. Q2 is going to be such a jump. Maybe we'll look year over year on that one too. But anyway, let's go through what I think are kind of the key metrics you want to watch to just track the health of this business. I used to start doing this. It's been really funny to me to watch. You can kind of go find maybe the first time I did this on probably Reddit or Twitter. And back then, Hedgie's whole drumbeat was how terrible AMC's fundamentals were and how it wasn't going the right direction. And so I was like, look, I can prove to you through this scorecard. And I think at one point I called this like the Anti-FUD scorecard or the FUD beater or something like that. And if you watch the fundamentals, you can just see the company improving. And so we knew that like 2 years ago. And now the narrative has flipped. Shorty likes to say, oh man, you guys are just about fundamentals. I'm here for the squeeze or whatever, and try to brush that off. Well, my point of view. You can find a video where I talk about kind of the end game and the fact that I think AMC turning profitable is ultimately, that kills the short thesis. And you've seen Adam start to use that language too, and I've said that for a long time. All right, so let's go through these details, and if nothing else, if you'd like to learn a little bit about business and how a business person looks at things, if you're new to my channel, I've got a master's in business. I've also got I've got 2 masters in business. Maybe I won't go into too much detail what the second one is, unless I want to out myself a little more. But anyway, 2 masters in business, and so I kind of have some background in tracking this type of stuff. All right, so cash on hand. We are at basically 519 million. You can that's current assets. Actually, there's more current assets than that. That's basically cash and equivalents. There's some restricted cash I've got in that number. So 496 million was the actual cash they had on hand. Usually restricted cash, you might set aside some things that it's kind of earmarked is what that means, but it is cash that they have. So this 519 is their total cash. I should have reworded that. That's not their total current assets. There's more than that in their current assets. That is down $670 million year over year. So you might say, oh my gosh, they're way down on cash. But look at this little fine print here. We're going to talk more about this in a couple other metrics. It's what I just told you also. So they're down 670 million in cash year over year. But if you look at their debt, their leases, and some other kind of liabilities that they've paid down $1.1 billion. So yes, they've used up this 670 million in cash. But in some ways, he's saying, hey, we had more debt than we needed. We don't need to hold all that cash while our debt is costing us money on the interest. And I can pay it off at a discount. So he's paid that off, 670 million paid off 1.1 billion and ran the business for a year. I'd say that's pretty good. We're moving the right way. So that's why I didn't call this one red. before anybody tries to jump on that. Yes, cash is significantly down, but that cash was leveraged and paid off even more debt. So I think that's great. But I'm also not going to give it a green because we're not moving up. And so I'd like to just, let's have some integrity to the process here. All right, so attendance. 47.6 million people went to an AMC this last quarter. That's up 22% over the last year. And you can see on the US side, that was up 25%. On the international side, that was up 15%. I'll be honest, I expected a little more aggressive growth than that internationally. So I was not quite correct there. But still great to see double digit growth in attendance in all markets. So that's great. Food and beverage, you can see we were up 30% on net revenue. So I look at that after the cost. And the reason I do that is because we know we're in an inflationary period. So I'm interested to see is what we're paying AMC keeping track with their costs. And so you can even see the second line. So first of all, we're up 30% on net revenue. The second line, they actually did lose 2 points of margin on that. So the costs went up a little bit more than what we were paying. That could also be a mix of food, like maybe we're buying, I don't know, Raisinets instead of sour gummy worms, and there's different profit margins on those. So I'm not too sure. I don't see the details on that, but I will just keep tracking that for all of us. How are they doing on their profit margins? But you can see that translated into almost $60 million more this quarter than it was the same quarter last year. Admissions, then, that's going to be real tied to attendance, but also tied to the ticket price. And so we're up $90 million year over year. That's 20% that we're up. You can see the ticket price was down about 14 cents year over year. Some of that is going to come, and actually in the food and beverage, in all of these, any dollar amounts, some of that's going to come from the relationship of the euro to the dollar. So I've said in a couple videos, any euro sales and costs get translated back over into dollars. And so if the euro goes down against the dollar, it can look like our European teammates are paying less per ticket to AMC. It basically makes it kind of go down. I don't want to explain FX, foreign exchange, too much here. We could talk about that another day. But basically, some of this minus 14 cents is in a way not real. If you look at something called constant currency, this number would be better. And that's only down 1%, so it's basically flat to last year. So we had more people coming. There's probably some, we had more movies too. So there's some of this that's maybe there were less blockbusters. So there's a few spots where people didn't kind of pay premium pricing. But overall, admissions up 20% is fantastic. How about our liabilities? So that kind of gets into something called the balance sheet. What are AMC's liabilities? I mentioned they've reduced those by $1.1 billion year over year. So some of that is paid off leases. They've got, some some back owed leases that basically landlords gave them, some flexibility during the lockdown periods so that the landlord could keep this key tenant alive. So that was great. There's some partnership, but now they've got to pay that back. So they have their debt, but they also have these this lease kind of boy, the word's not coming to me, guys. But basically, past leases that are still due, and so they've paid off $1.1 billion of that. That's down 9% year over year, so that's great progress. That means their liabilities went, you can see, from $12.5 billion now down to $11.4 billion. That's a great thing. They're moving the right direction. You want your assets to go up and your liabilities to go down, and you want your cash to improve. Just watch those three things. And if those three things happen, our stock is going to go up. And Shorty eventually is going to be pressed to get out of this thing. All right. Operating expense as a percent of revenue. So I mentioned earlier fixed costs versus variable costs. What I'm looking at is, for instance, I knew long ago, I started tracking this like 2 years ago, well, wages are going to go up. Or for instance, as more movies come in, they may have to hire more shifts, like have more workers. And so I knew their cost of just operating the business, keeping the doors open, letting us in, scanning our tickets, selling us our food, whatever. All of that was going to go up. I knew that. So what I wanted to track is it going up faster than revenues or not? You want revenues to be going up faster than operating expenses. So year over year, you can see we have an 8% improvement. Last year at this time, operating expenses were actually more than revenue. Operating expenses were, you can see this, 1.02 times revenue. This year at this time, it's all the way down to 94% or 0.94 times revenue. So we've moved to a place where now operating expenses are actually less than revenue, even in the worst quarter of the year. Remember, this is going to be the worst quarter of this year. So that's great. I'm watching revenues grow faster than operating expense. And so are you because you own this stock. Free cash flow. I mentioned in another video recently that free cash flow is a very important metric. Effectively, in a way, it kind of says, so if money's coming in and money's going out, is there ever sort of an amount of that the company sort of has a lot more flexibility to use, and it's kind of generating above a lot of their obligations? I'm not explaining that super perfectly, but you get the idea. That improved by almost $100 million. dollars. So you can see free cash flow improved by $93 million. Dollars. That's a 28% improvement. Just want to be clear with you, that is still negative, okay? But this scorecard is just tracking direction. Are we moving the right direction? Because that's all I've ever said from day one, and you can find Reddit posts of mine like 2 years ago, that this company had enough runway to survive, it was not going to go bankrupt, and eventually that was going to be a real problem for the shorts. And that has played out. That's where we are. So just want to make sure I'm not misleading you, though. Look at the fine print on that one. It says we're still negative, but we improved from a free cash flow of negative 330 last year in this quarter to negative 237 this year. And remember, there were some big expenses like the debt pay down and some other things that were in some ways by choice too. So that could have been better. And eventually they'll make the choice, the conscious choice to have better cash flow when they need it. So I have no concerns there. Okay, accounts payable and receivable. This actually directly relates to that cash flow I just talked about. It's sort of like, can I slow down paying money out while I speed up bringing money in? So accounts payable is what do I owe people? Think of that in some ways almost like you got it on your credit card. Bigger companies will have these like terms like a net 30 or something. Okay, I'm going to pay you in 30 days at some kind of discount, or maybe it's just the amount that I would have owed anyway. And so if I wait to pay you, say, 30 days because I just ordered, I don't know, a million kernels of pre-popped corn. Side note, what do you call that? Like, I was going to say a million kernels of popcorn, but it's not popcorn because it hasn't been popped. So a million kernels of corn? Dried corn? I don't know. Anyway, someone figure that out and help rescue me from this ramble. Okay, so here's the point. Say you order those million kernels of corn and you wait 30 days to pay them. So you've got an accounts payable that would show up in your bills, basically. But say in the meantime, I don't know, someone else owes you money, and so that's an account receivable, but you kind of hustle that in before those 30 days. Be really great if you get the money in before you need to pay money out. It kind of helps your cash flow. So what I'd like to see in general is either those keep pace with each other, or perhaps accounts payable goes up faster than accounts receivable. It's a little bit of a metric to just say, is a company managing their cash flows? You can see in this case, accounts payable was down by 38 million and accounts receivable was only down by 100,000. So in effect, that made the cash flow a little tighter this quarter. So I'm giving that a gray and kind of this little yellow down arrow, because that was a downtrend year over year, but also it's nothing that I'm getting concerned about. Like, have plenty of cash, and I'm sure if they really wanted to, they could have managed that. It's nothing I'm overly concerned about, but I want to just be real with you guys and show you consistently, these are the things I've measured for 2 years now. And I'm going to stay consistent with that, whether I like the numbers that show up or not. All right, so then finally, just their overall, what's their net loss or gain? So that, again, remember, we know this quarter was a loss. So follow me carefully on this one so I don't overhype or anything. We improved by $104 million from the same quarter last year, just on the bottom line. What was our earnings? Improved by $104 million, 31%. So let's go back. Like I've talked about, food and beverage was up 30%, admissions money was up 20%, attendance was up 22%. But yet, look at this net loss and gain. In this case, a net loss, but we improved it by 31%. That outpaced the growth of revenue. When earnings is outpacing your revenue growth, that is a really good thing in business. That's leverage. That's exactly what you want. You always want earnings outpacing sales growth, and sales growth, I'm kind of from some supply chain backgrounds, so you want like sales outpacing inventory, but that's a little different here. Okay, so in this case, we went from a negative 337 to a negative 234. Still a loss. Want to be clear about that. But hold on and stick with me to see what's coming here in a minute. Or I hope some people have fast forwarded to the good stuff. I don't know. So the bottom line, this was the best Q1 of post-COVID yet. I guess it's only the third one or something. So That's probably not too huge, but I'm telling you, you can see all this green, how much bigger it is. And despite it being Q1, if they hadn't done that debt pay down, if you kind of excluded that debt pay down, this would have been the second best post-COVID quarter for the bottom line of all of the quarters. So that it's a pretty big deal. This was a good quarter. Um, we're going in the right direction, and that's even without the box office being huge. So you know that there's been basically improvements to the fundamentals, as I said. So even as the box office kind of hadn't grown yet, but their earnings were growing, that just tells you they're really tightening their game. All right, so all metrics, you can see that on the screen here, basically other than that APAR relationship, kind of improved significantly. The reduction in cash, I told you, was used to leverage the balance sheet, so they paid off. Basically, it's 64% more liabilities than the cash used. So that 1,100 million, or the 1.1 billion, but they only used the 670 million of cash. So there's leverage happening. The balance sheet is improving faster. That's great. Operating expense, so people in business call that OPEX. As a percent of revenue, I mentioned that continues to fall, and I believe that's about to improve by a whole heck of a lot in Q2 because of the box office. And then looking forward, so Q2 is tracking actually to net profits. I've said that in a couple videos. I still believe bottom line, we're going to see profits. That's a forecast. You cannot quote me on that. I do not have a crystal ball. I could be wrong, but I believe we're still tracking to that. So let's check my forecast from Q1. I like to save my numbers and then see how I did. And actually, this is part of what's allowed me to start feeling more and more willing to share with you guys more of my numbers. I just hadn't wanted to give any hopium in the past. What if I'm wrong, kind of a thing. So you can see on revenue, I was really close. Basically, I was 96% accurate. I was forecasting 993 on revenue. They landed at 954. Some of that, probably the biggest miss I had was kind of in other revenue. I think I probably overestimated merch sales. But, hey, I mean, I was only off by 3.9%. I'll take it. To me, that's a win. OPEX, boy, I nailed that one. So OPEX, I was 99.6% accurate. It was 0.4% over what I forecast, or $4 million in this case. So you can see I had forecast OPEX would be a little over $1 billion, and it was a little over $1 billion. So I nailed that one. Part of that is because that's kind of a variable cost, and so I've just got some formulas where I've tracked this over quarters, 15 to 20 quarters to try to nail down what that is. Other costs. I was within 2.5% if you take out kind of one-time expenses, but I was well off. Like with their kind of one-time expenses this quarter, I was off by like 50%. So other costs kind of bit me. I think that was maybe I was off by, I don't know, 40 or $50 million on that one. So it's not huge in the grand scheme of their overall earnings for the quarter, but that'll be one I'll have to dial in. And then cash. So I had done a video where I told you what I thought the cash landing position would be. Boy, guys, I almost got that one like perfect. Now, you could look at this and say, wait, retail, you were off by $100 million. But remember what they paid off in debt. They basically paid off $100 million of debt. So if you kind of take out, and I had said in that video that there's going to be sort of surprise expenses that I don't know about that are strategic. Well, I'll call that strategic, and I'll chalk this one up to a victory. Because they exactly landed on what I said they would if you sort of factor in that debt payment. So I'm pretty thrilled about that one. I got the cash right. And I just think that continues to establish credibility. This is 3 or 4 quarters in a row where I've been real close. So I'd like to think if there's people out there scaring you and you come listen to me and say, okay, what does he say? That I'm starting to establish over time that I'm going to get it right. There's going to be some quarters I'm probably going to be way off. It's going to be coming, so I don't want to dunk too hard here. Reminder, though, the total liquidity is actually a little over $700 million. That's a lot of cash that AMC has access to because they have another $200 million in their lines of credit. I'm just referring to things he said on the call and things you can see in their earnings release. Okay, enough of that. Let's talk about the fun stuff. So let's look at the last 3 quarters. And so now we're going to kind of start to move in what's coming. Look at those last 3 quarters, and you can kind of see how low. Those are the domestic box office. Those are actuals. Those are real numbers. You could go, I've told you, like Box Office Mojo. There's a website called thenumbers.com. There's a lot of places, Box Office Pro, Box Office Report. I look at all those. And so go find that information. You can check this so that there's no trust me bros here. Those are our last 3 quarters. Look at that compared to the next 3 quarters of my forecast. And by the way, here's a really fun thing if you hadn't seen. There's some people on Twitter who had tweeted out the numbers.com. They're kind of more of an analytical site. They have, I think, a little more data science behind what they do. Um, they are now saying they think the box office this year will be $10 billion. Dollars. Just so you know, in everything I'm showing you here, I've basically got a $9 billion forecast on the year. So there is an industry website that's saying there's another $1 billion in the domestic box office. Let's call that like 11% higher than what I'm forecasting. I don't have to tell you, but if there was another $1 billion worth of attendance, and behind that is food and beverage sales and merch sales and obviously ticket sales, that's freaking big, guys. So everything I'm showing you is going to be bullish, and just know that there's an industry website saying it's like bullish times two. So that's pretty cool. I have not upped my forecast to what they're saying yet. I'm not convinced yet, but I am hoping they're right and I'm wrong. Let's be real about that. Okay, here's the thing. Check out Q2 of actually, I think that's wrong. It was I'm about to show you something wrong. It was Q4 of 21. So I'm going to show you an arrow, but now we're going to have to ignore this. If I could take, so if you're watching, I'm hovering. If I could take this arrow and make it go down here to this Q4. So look at this Q4 here. That's when Spider-Man No Way Home showed up. Now you got to remember, like, there were a lot less workers. There's a lot of kind of expenses that were different there. But the AMC had positive free cash flow. They've done it before. It's happened. They had positive free cash flow. They had positive cash from operations. So they generated cash that quarter. And either one you want to look at, I've almost made it like more favorable for Shorty here because it would look even better if I'd drawn it down here. We had this positive cash flow quarter. And look at what these next 3 quarters look like. The box office is way bigger than that. And so I had talked about this in that sort of earnings preview because I wanted you to know what's coming. So I won't go too long on this one here. We'll go quick. But you can just see, so Q4 of 21, we had that positive cash flow. Look at what the domestic box office was. We're 34% probably bigger this time than then, this Q2 versus that Q4. Back then, Europe still had sort of COVID headwinds. Not everything was open. Now everything's open. So you're going to see, because I'm talking about domestic box office growth, so Europe will probably grow even faster. You can see the debt was at 5.2. I've actually got to update this now. We got new numbers on debt, but we have lower debt now than that quarter that was positive cash flows. The food and beverage per attendee. That's another one. I nailed that on the forecast. I think I had said, I don't know, I was off by like 4 cents per person. I have to go back and look at what that was, but it was real close. So I'm confident that we're going to keep tracking something close to my forecast for Q2. So you can see that's a lot higher, which means if the box office is higher, more people are coming and they're paying more per person for food and beverage. That number is going to be way up, all against a quarter that we already had positive cash flows. So you can kind of go through this sometime, but we have popcorn now. We didn't have it then. We have the credit card now. We didn't have it then. So if we had a positive cash flow quarter before, when the domestic box office was way lower, and that implies all the food and beverage sales, plus we have popcorn, plus we have the credit card, I think you can understand I'm saying the rest of the year, the entire rest of the year, I believe if you combine, like smush those 3 quarters together, AMC will have positive cash flow. That is not going to be pleasant for Shorty, while Shorty is burning cash. So that's what I kind of had a laugh about in that video, and I'll do it again here, is they like to taunt us about cash burning, that AMC is burning cash. I'm telling you, I don't think AMC has negative cash flows between now and who knows how long, because 2024 gets even bigger and then 2025 gets even bigger. So Shorty's got cost to borrow and is burning cash by the day. Meanwhile, I believe the April that just finished, which was the 3rd biggest April of all time, by the way, at the box office, the April that just finished and the May and June we're in, I think AMC is generating cash. That's my point of view. Let's just look a little bit more about that fun stuff. Here's a view of the domestic box office. It's a rolling year, so I just kind of combined the last 4 quarters so you can see what we just finished. And I had kind of told you about this, that we needed to just kind of get through this, or if you look back here in past forecasting videos, I had told you we needed to finish Q1. That's why I call this the fun part, because now we're in Q2 and you can see the difference that you're about to be living in in terms of business results. That we just did these 3 quarters and now we're in these three. So if you look at that kind of rolling year view, it is just up and to the right because of the quarters that are coming. And I base all that, I've told you in other videos, on a combination of industry forecasts and my own. Mario's a great example where I think I had a $405 million domestic forecast. That was way under what it landed, but even my forecast was far bigger than what most of the industry said. So, and there's been a few others where, kind of like John Wick is one, I think I nailed it. There's some where I miss it for sure. And overall, though, as the total domestic box office, I've been getting that one real close to. Like, I don't think there's been a quarter I've been below sort of like 95% accuracy or 94% or something like that. Um, so I say that to say, yes, I'm showing this up and to the right, but that's based on a lot of industry research across 4 or 5, different sources for each movie. I'm basing it on the actual movies coming out, the timing of when they come out, how much revenue carries into a different quarter. Like, say, Indiana Jones comes out the last day of the quarter, how much revenue carries out to the quarter after. So then you can see, like, what does this whole year look like? And so look at kind of from calendar 21 to 22 to 23. Look at that up and to the right. And remember, so here's this kind of 9.1 billion that I'm saying. That website, thenumbers.com, is now saying 10 billion. Imagine if we hit 10 billion this year. And then I've got actually more like 10.3 next year. So the movie industry up and to the right. I love telling Shorty about that one. They're shorting an industry that is up and to the right. And your stock is a movie stock. And this is what movies are doing, up and to the right. It's a big deal. Okay, let's not forget candy. So if you didn't listen to the earnings call, or I don't know, you've been under a rock, hadn't seen the tweets or the news articles, pretty fun that, in addition to the popcorn that we love, which I've been having plenty of that, we're going to end up getting candy. So I hope Adam's able to help the team go fast with that. I really appreciate that he took the time to make sure there was quality in the popcorn. I'm sure they're going to do the same with the candy and make sure it's of a high quality. So that's great. I appreciate and respect that, and I want it now. So two things can be true. I can want that in a hurry, and I can respect the time they're going to have to take to get that right. I think he basically said we won't see that till 2024. I don't know. I could tell in the call he was kind of trying to say he wanted them to hurry up as well. So let's just see when we get that. But that is on the horizon. That's pretty exciting. The bottom line from all this, that was the biggest Q1 of post-COVID ever. This is the lowest debt we've had since well below COVID, since well before COVID. This Q2 that we're in now is the biggest post-COVID box office, and it's just not even close. It's actually like 60% above Q1, and I think it's, I don't remember, maybe 25% or something above our biggest quarter we've ever had. So it's a really, really big quarter. The final 3 combined quarters, I believe, will easily be positive EBITDA. Adams also said that, by the way. But also, I think they're going to maybe, hear the word maybe. I'm not real confident in that one. But there's a shot. There's a puncher's chance at the final 3 quarters combined having positive net income. I guess it doesn't say that here, but the positive net income. That's that bottom line. Positive earnings. There's a chance. Let's see if that website, thenumbers.com, is right and it's 10 billion on the year, then I see positive income almost for sure. If I'm right and it's this 9 billion number, it's going to be real tight. It's going to be close. But there's a chance those final 3 combined quarters could be positive net income. And then we got candy coming. I mean, I don't even know how you troll this anymore, other than what I've seen on Twitter a lot, and maybe just a quick plug. I've seen some drama. I've seen some arguing. I've seen some attempts at spreading negativity. And then people get a little tired and they get grouchy with each other. Hedgie really wants to mess with your mind. If you feel that, whatever your circles are, be it here on YouTube, out on Telegram, Facebook, Twitter, where's everybody else? I don't know, Reddit, wherever you are, whatever your circles are. And I've got some real life friends who aren't even tracking AMC on social media. So by the way, understand, apes, you're bigger than you realize. There's people who aren't even on social media with us who are holding. My mom is the perfect example. She has never sold a share. She's been in since a very high price point, and she's just holding. And so, she's not on any of these forums with us. She probably doesn't even really quite understand all that I'm doing in this community. I tell her a little bit, but anyway, that's a side note. The point is, I know for myself, there's times where if I'll take a step back, maybe I'll just pause Twitter for a day, or I'll go for a walk, or whatever it is you need to kind of step back, take a breath, and breathe. I'll even say, I said on Twitter yesterday, even slow your heart rate. Like, pause, take that real deep breath, slow yourself down, find the calm you need. Because what Hedgie wants you to be is scrambled and agitated and on high alert. And you just can't do that day after day, hour after hour, minute by minute, and really function really well and think really clearly. And that's when they can start, hitting you with their FUD. So I just highly recommend finding ways to just chill and calm down. And, to that end, honestly, it's really easy for us to win. At this point, Hollywood's done their job. They're bringing us the movies. This is so easy, even an ape could do it. See movies, buy popcorn, use card, and use the AMC on demand, and we're gonna win. Let's go.